$0 is what Illinois taxes on your Social Security, pension, 401k, and IRA withdrawals this year. But the average Illinois homeowner still pays $5,277 a year in property tax, a bill that does not check your income. For the exact same house, that bill is identical, whether you retire on $30,000 a year or $300,000. Illinois is not tax-free. It just moved the bill from your income to your house. This video covers what that actually costs a typical retiree, not someone sitting on millions plus a third tax. Most Illinois retirement videos skip entirely. The one that decides whether this state ends up cheaper or pricier than wherever you are comparing it to. Let's start with what is actually true, because it is a real number, not a marketing line. Illinois exempts 100% of retirement income from its state income tax. An exemption just means income the state agrees not to tax at all. That covers Social Security, pensions, both public and private, 401k withdrawals, and IRA distributions. There is no income cap on this exemption and no age requirement. A 62-year-old pulling $40,000 from a 401k gets the same 0% treatment as a 78-year-old living on Social Security alone. This is not a small carve-out. Illinois has a flat state income tax of 4.95%, and that rate applies to wages, business income, and investment income. Retirement income simply is not part of that calculation. On paper, it is functionally identical to living in Florida or Tennessee, states that get all the credit for having no income tax at all. Here is what that means in real dollars. Take a retiree with a $45,000 pension and $18,000 a year in Social Security. In a state that taxes retirement income at even a modest rate, that could mean a few $1,000s a year in state tax. In Illinois, the bill on that income is $0. If you have family in Illinois, you have probably heard the other side of this conversation too, a cousin or a neighbor who packed up for Florida or Indiana specifically to escape Illinois taxes. That move happens, and it is not irrational. IRS migration data has shown Illinois losing more residents than it gains most years for over a decade now, and Florida and Indiana are consistently among the top destinations for the people leaving. But most of the people making that move are reacting to the property tax bill and the state's overall reputation, not to any tax on their actual retirement income, because there isn't one. So why does Illinois never show up on the same best states for retirement taxes lists as Florida and Tennessee? Partly because Illinois carries a reputation problem, high overall taxes, a well-known pension funding crisis, and years of headlines about the state's finances. If you have spent any time around Chicago or downstate cities like Peoria or Springfield, you have probably heard some version of that reputation repeated as settled fact, usually by someone who is not looking at their own tax bill line by line. None of that reputation is false, but none of it changes the specific fact that your actual retirement income, the Social Security check and the pension, and the 401k is not taxed here. Let's make this concrete for a couple, not just one person, because most retirees are not moving alone. A married couple drawing $80,000 combined from 2 Social Security checks and a joint pension pays $0 in Illinois state income tax on that $80,000. In a state that taxed even a modest slice of that at 3%, the same couple could be looking at roughly $2,400 a year in state tax on income they already planned their whole retirement around. But taxes come in more than one form, and Illinois collects its money somewhere else. Illinois makes up for that missing income tax revenue with property taxes, and this is one of the defining facts about living in this state. According to a 2025 property tax analysis from Ownwell, the median annual property tax bill in Illinois is $5,277, based on a median home value of about $227,000. That works out to an effective rate of roughly 2% of the home's value every single year, which just means about $2 for every $100 your house is worth, billed annually. Nationally, that rate is among the highest in the country, trailing only a small handful of states like New Jersey. To put that in perspective, a retiree who owns a home worth the state median pays more in property tax alone than many retirees in other states pay in property tax and state income tax combined. There is another layer here that specifically affects retirees: the senior freeze programs that many Illinois counties, including Cook County, offer to older homeowners. These programs can lock your home's assessed value, the number the county uses to calculate your bill, in place so rising property values do not automatically raise your tax bill. That sounds like real relief, and for many retirees it is, but there is a catch. These freezes are not permanent and they are not automatic. You typically have to reapply every single year, and if you miss the paperwork deadline or your income moves even slightly past the program's threshold, the freeze can lapse. When that happens, your assessed value resets and your tax bill can jump back up all at once. Homeowners who assume the freeze was a one-time application have been caught off guard by that reset. Here is what that actually looks like for one homeowner. Say a retired couple bought their home years ago for $150,000, and it is now assessed at $300,000 as the area has grown. Without a freeze, their tax bill rises every time the assessed value rises. With an approved freeze, the county holds that $300,000 assessment in place, so future increases in the neighborhood do not show up on their bill as long as they keep filing the paperwork on time and their income stays under the program's limit, miss a filing deadline, or have a year where you sold some investments and your income spiked, and the freeze can lapse without much warning, and the bill catches up to the current assessed value all at once. This is the trade at the center of this video. The state is not taxing your income. It is taxing your house at one of the highest rates in the country and asking you to do paperwork every year if you want any break on that. If that trade-off is new information to you, that is exactly the kind of thing this channel exists to lay out state by state with real numbers instead of a headline. Subscribe now so the next one shows up when we cover it. There is a third tax that gets brought up in almost every Illinois retirement video: the state estate tax. Illinois has its own estate tax, separate from the federal one, with an exemption of about $4 million and a top rate near 16% on the value above that. If your estate, meaning everything you own when you pass away, is worth more than $4 million, the amount above that threshold can be taxed at a meaningful rate. Here is the problem. A lot of worst states to retire content leans heavily on the estate tax to make Illinois sound dangerous for every retiree, when in reality it only applies to a small slice of retirees with unusually large estates. If your home, retirement accounts, and other assets add up to less than $4 million combined, and for most people that is the case, this tax simply does not apply to you at all. If that describes you, you can stop worrying about this specific tax right now and focus on the property tax bill instead, because that is the one that actually reaches everybody. For the smaller group, it does affect, here is what it looks like. A retiree with a paid-off home, a retirement account, and other savings adding up to $3.5 million owe zero Illinois estate tax today because that is still under the $4 million line. But that same person is close enough to it that a market run-up or a home value increase over a few years could push the estate over without them doing anything differently at all. If your own numbers land anywhere in the $3 to $4 million range, this is not something to panic about. But it is worth checking again every few years, not just once, and forgetting about it. One more detail explains why this tax comes up so often, even though it affects so few people. The federal government's own estate tax exemption is roughly $13.99 million per person for 2025, far higher than Illinois's $4 million. A lot of estates that owe nothing at all to the federal government can still owe Illinois money because Illinois set its own bar so much lower. If you have heard someone say, "My estate is federal tax-free, so I don't need to worry about this," that statement can be true federally and still leave an Illinois bill on the table. If you actually want to know where you stand, the exercise is simpler than it sounds. Add up your home's current market value, every retirement account, any other savings and investments, and life insurance payouts that name your estate rather than a person as beneficiary. If that total is nowhere close to $4 million, you are done. This section does not apply to you. If it is within a few $100,000 of that line in either direction, that is the specific situation worth revisiting every couple of years with a professional, not something to solve by watching one more video. Income tax and property tax are the two big, easily quotable numbers, but if you are actually comparing states to live in, a few other costs deserve a place on the list because retirees consistently say these are the ones that catch them off guard. Home and auto insurance. In Illinois, run close to the national average, but that is worth confirming for your specific area since rates vary by county and by how exposed you are to severe weather, including the tornado risk that central Illinois shares with the rest of the Midwest, and the flood risk along the Illinois and Mississippi rivers. Utility costs are another line item that rarely makes it into a best and worst states graphic, but shows up every month on a real bill. Illinois winters mean 4 to 5 months a year of real heating costs, and a retiree moving from a warmer state should budget for that as its own line item, separate from any tax discussion entirely. It is not a huge number on its own, but stacked on top of a $5,000 property tax bill, it is one more monthly cost that a 0% income tax headline never mentions. Healthcare access is worth a mention too, even though it has nothing to do with taxes. The Chicago area has some of the largest hospital systems in the country, which matters if you want a deep bench of specialists nearby as you age. A smaller city like Peoria or Springfield still gives you real hospital access, just a smaller one. The more rural stretches of the state, further from any of those cities, mean fewer specialists and longer drives for anything beyond routine care, which is worth weighing honestly if the specific town you are looking at is an hour or more from the nearest hospital system. And then there is sales tax. Illinois' base state rate is 6.25%, but that is only the floor. Local governments add their own layers on top, and in Chicago, the combined state and local rate reaches roughly 10.25%, one of the higher combined rates in the country. A downstate city like Peoria charges less. It does not apply to groceries and some essentials at the same rate as general purchases, but on ordinary retail spending it adds up over a year, layered on top of that already high property tax bill. One more practical item, especially for anyone looking at a smaller downstate town rather than a Chicago suburb. Check internet and cell service for the specific address, not just the town. Rural stretches of Illinois can have real gaps in broadband and cell coverage, and that matters more than it used to for retirees managing banking, telehealth appointments, and staying in touch with family remotely. None of these numbers are secret. They are just easy to leave out when a headline only has room for one statistic: 0%. Let's put a real number on this using the typical retiree from Section 3. A paid-off, or nearly paid-off, home worth around the state median, a modest pension, Social Security, and a retirement account in the low to mid six figures. No estate anywhere near $4 million. On the income side, state income tax owed on Social Security, pension, and 401k withdrawals is 0. That is not an estimate, that is the law confirmed for this video against Illinois Department of Revenue guidance. On the property side, a home near the state median value carries a property tax bill around $5,277 a year, the number we opened this video with. If that home qualifies for a senior freeze and the paperwork stays current every year, that bill can be held from climbing further as home values rise, but it does not start out lower. On the estate side, 0, because this retiree's total estate sits well under the $4 million exemption. So for this typical retiree, the honest total tax picture in Illinois is a $5,000 range property tax bill and nothing else. Compare that to a state that taxes retirement income directly, a modest 3 to 5% state tax on that same pension, and 401k income could easily add another $1,000 to $2,000 a year on top of whatever property tax that state charges. Illinois does not charge that layer at all. That does not automatically make Illinois cheaper than every alternative. Property tax bills vary enormously by county within Illinois itself, and a retiree buying a larger or newer home will pay more than this median example. Using that same roughly 2% effective rate, a $250,000 home close to the state median lands close to $5,000 a year, matching the number we opened with. A $400,000 home in a suburb like Naperville lands around $8,000 a year. A $150,000 home in a downstate city like Peoria lands closer to $3,000 a year. Same state, same tax rules. A $5,000 a year swing just based on where you buy and what you buy, which is exactly why the average Illinois retiree pays X. Framing you see in other videos is close to meaningless without knowing which Illinois you are actually talking about. The practical version of this, before you fall in love with a specific town or a specific listing, pull the actual property tax bill for that address from the county assessor's site. It takes a few minutes and it replaces a guess with the real number. The single scariest number thrown around about Illinois, the estate tax, is irrelevant to this retiree. The number that actually matters, the property tax bill, is knowable, budgetable, and in many counties at least partially manageable through the senior freeze if you stay on top of the paperwork. So, which retiree are you closer to? The one where none of this touches you beyond the property tax bill, or the one where the estate tax is a real planning question worth checking every few years? Tell us in the comments, because that answer changes what the rest of your Illinois decision should actually weigh. And if this changed how you saw that 0% headline, that is worth sharing with whoever you know that is actually house hunting right now. So, where does this leave you if Illinois is actually on your list of places to retire? The income tax exemption is real, and it is one of the most generous in the country, tied with true no-income tax states like Florida and Tennessee for retirement income specifically. If most of your income comes from Social Security, a pension, or retirement account withdrawals, Illinois will not touch a dollar of it. But you are choosing a state with one of the highest property tax burdens in the country, and that cost follows the house, not your income. A smaller, less expensive home meaningfully lowers that bill. A larger home in a high tax county can push it well past the median we used in this video. If you are seriously considering Illinois, get the actual property tax bill for a specific address you are looking at, not just the county average, before you commit to a number in your head. And if your estate is large, the estate tax is a genuine planning question worth a conversation with a professional who specializes in that, separate from anything in this video. If you are actually working through this decision right now, here is the short version of everything above in order. Check whether your retirement income is the kind Illinois exempts, which for almost everyone reading this, it is. Pull the real property tax bill for the specific address, not the county average. Add up your total estate only if you are genuinely in the millions, and if you are not, stop there. And budget the sales tax, insurance, and heating costs the same way you would in any other state, because none of those move just because the income tax line reads 0. This is the pattern worth remembering anytime you see a single tax statistic used to rank a whole state. Ask what it leaves out. Illinois genuinely does not tax your retirement income. It also genuinely charges some of the highest property taxes in the country. Both of those facts are true at the same time. If this kind of full picture is useful to you, subscribe, because we are going state by state doing exactly this kind of honest breakdown. No scare tactics, just the real numbers. And if you know someone weighing a move to Illinois or anywhere else on a fixed retirement income, send them this video before they make a decision on half the story.